Hi, I'm Salman Ahmed. In this segment of our Steadyhand 2021 Where to From Here, we're going to be talking to two of our managers on how they've positioned themselves for a world post-vaccine. Anne Goodefin is the manager of our Global Equity Fund. She's the Chief Investment Officer at Velan, and she's been managing our Global Equity Fund since September 2018. Gord O'Reilly is a Senior Portfolio Manager at Fiera, and he's been managing our equity fund since its inception almost 14 years ago. And we thought this would be an interesting discussion because you've both taken very different approaches to building a portfolio for that post-vaccine environment. And I want to go to you first on this because of all our managers, you've been positioned most for an economic recovery and maybe even a recovery post-pandemic. Maybe take us through some of the adjustments you've made in your portfolio over the last 10 months or so.
Thank you, Salman. You know that there is nothing more than we like at Velan than when there is fear, because fear creates dislocation in prices and it allows us to pick us great opportunities, great bargains. And if we go back to March or April of last year, there were a lot of companies that were having very tough current trading conditions because some entire part of the economy had come to an halt. But when they would recover in 3 to 5 years, which is our investment horizon, they would be great companies, and they were at that time very lowly valued. So we bought a few of those, and then fast forward, there is finally light at the end of the COVID tunnel. A vaccine is coming with a high efficacy rate, and these stocks have started to re-rate. In some cases, like a company like Woodward, that would come to my mind, they've reached our intrinsic value, they've recovered to the price level they were trading at before the pandemic, end of 19, beginning of 20, so we decided to sell, but we have quite a few stocks that are still in the portfolio and should do really well when the economy recovers.
Now, Gord, you've taken a slightly different approach to this because you haven't made a ton of changes to your portfolio. There's been some buys and sells here or there, but not to the extent that Anne has. Maybe take us through what your approach has been.
Well, I mean, the great thing about investing, Solomon, is that Anne can get to a great endpoint, and we can get to the same endpoint, hopefully doing well for your investors. But it can take two different routes. And our fundamental belief is that we want to have companies that have sustainable business drivers, in a similar time frame to Anne's, 3 to 5 years. And we think there's going to be a bit of a cyclical bounce, but we're not too sure of how quickly that's going to come. We saw the retail sales number today being quite weak, and we think there's a lot of talk about pent-up demand, but 70% of the U.S. economy is services, and not that I look like I need a haircut, but you can only go and get one haircut. I can't get 9 months of new haircuts. So we think things are going to be a little bit slower to rebound. And so we'd prefer to play it with something like a Visa, where 25% of their revenues come from cross-border travel. Cross-border travel is down, and travel miles are down about 75% in 2020. And we think there'll be a little bit of a tailwind, but it's still a strong secular grower.
And Gord, I want to stay on retail for a second. You just mentioned it. Retail is one of those industries that has a big cloud over it right now. There's a lot of uncertainty about whether people will indeed go back and shop in person. You've got some exposure there in Couche-Tard and Metro. So is it going to survive, or do these businesses have to really change to survive post-pandemic?
Metro is a grocery retailer, for those who are not familiar with it. We think a company like that, there may be sort of more delivery mechanisms rather than going into store in the future as people have adapted. But we think it's a strong cash flow generator. It will benefit from food inflation that we're all seeing right now. So we view it as a very defensive holding. We think there'll be a snapback in some of the retailers, like certainly I haven't bought a suit in over a year, and who knows, this is the first time I put on a suit in a while. But some of those stores may snap back. But again, we're trying to create a very defensive portfolio with high degree of cash flow certainty, and we think a grocery retailer provides us with that.
There's those types of businesses that will come back and those that won't come back. What are some of the names in your portfolio you think that are going to come back but that investors are maybe counting out right now because of just that heightened uncertainty?
Salman, you know that during these upheavals, people are forecasting that the world after would be totally different. I would be much more on the side of Sir John Templeton, who was a famous value investor and a very wise man, who said that if 20% of the changes forecasted would stay, that would already be a high percentage. And that's why at Velan, we did a lot of work on companies where the stock price was badly impacted, but we saw that at the end, the business model wasn't going to be that impacted. It might actually continue to grow. Let's look, for instance, at trade shows. That's where when you operate in an industry, you meet all your industry contacts, your clients, your suppliers, and nothing would ever replace the face-to-face interaction. So that's why we're very confident about the future potential of this company. And we were able to buy the number one organizer of trade show, Informa, where 70% of their business comes from a position where they're number one or two in industry trade show. And we were able to buy it at almost like a 50% discount to what we thought was their final value. I would like to add that what also we liked about the Informa investment case is that from an ESG perspective, it had a very good rating. There was really no subject of objection on this company. And even more, they are contributing to the community. They also have a smaller book publishing division, and they make this content available to disadvantaged communities. So it was definitely a plus in the investment case.
Thanks, Anne. I want to talk about an industry that we know we're going to need more of, and that's healthcare. Definitely the pandemic has shown us that it's needed more than ever. But the performance of companies in the healthcare industry has been a bit of a mixed bag. Gord, I'll go to you for this one. Maybe just explain why that's been the case over the last little while and how a couple of names in your portfolio have been impacted by it.
Well, thanks, Salman. I guess there was two sorts of healthcare companies. One that benefited from the pandemic, and others that had surgeries and other businesses interrupted by the pandemic. If you needed a heart surgery initially during the pandemic, it was hard to get a bed. So some of those businesses were impacted. As I mentioned earlier, we're always trying to think of companies that have 5-year long-term growth drivers behind them and sustainable drivers in that. We've invested in a company called Danaher, which has transformed itself from more of a business conglomerate to a healthcare focused company. And, its earnings were expected to be up about 37% in 2020. Certainly not, it wasn't that high when we bought it, and they're expected to be up another 20% next year. So it's been really strong beneficiary of COVID because they're helping develop the drugs for all the warp speed vaccines and about 400 other biologic candidates. So that's benefited tremendously. And also the other thing we like with Danaher is it's well diversified. They have some businesses, as you mentioned, that were impacted by the slowdowns. So we think there'll be a cyclical uptick. But as well, they generate a huge amount of free cash. Their free cash flow is greater than their net income, which means they can continue to reinvest in their business at high rates. So that's one that we ascribe to and we're still very confident in.
And I'll come to you because you've had one of your largest investments, Zimmer, is one of the businesses that Gord just references. It's been impacted by COVID because people aren't able to do surgeries anymore. So have you had to adjust your thinking on healthcare at all?
If you mention specifically Zimmer Biomet, I think it's a name you're familiar with because I mentioned it at previous conferences, but maybe a reminder that they're the number one in terms of hip and knee replacement. Obviously, during the pandemic in March, April, businesses dropped by like 90% because the only emergency surgery were practiced, but these surgeries are just postponed. So we're very confident that the business is going to come back. And we added quite significantly to the position in March, April. And I think the stock has sort of rebounded like 70% from the bottom, but we're still very confident about the long-term prospects of Zimmer.
I want to switch to technology right now. It's been the market darling over the last few years, and Gord, that's helped you over the last year. You had an outstanding run in 2020, and some of that came through some of the technology companies you own. But given the run that they've had, do they still have legs? Once we have this vaccine, or has all that been built into the price? Gord, I'll go to you for that one.
Thanks, Salman. For sure, the technology companies had a great run in 2020 because a lot of the work from home and digitization was brought forward, a couple of years of revenues potentially into these companies. We've owned Microsoft, which has done quite well. We still think the digitization trend is ongoing, and they're certainly a leader in that. They're a partner with business, and we like that. We like the fact that they've got a net cash on their balance sheet. And we differentiate a Microsoft from a lot of the other technology holdings. Microsoft has real earnings, real cash flows. There's a lot of companies out there that actually terrify me right now. A company like DoorDash, which has, $3 billion in revenues, has the same market valuation as FedEx that has $80 billion in revenues, and clearly, I don't think that's going to end well. But we're still confident that Microsoft is a long-term winner. But maybe it pauses for a little bit as the earnings catch up with the valuation. But short-term, we're comfortable holding it.
And you've got very little in the way of technology in your fund. What's held you back on that?
Valuation. We saw that many of these stocks were too highly valued, and we prefer to be strict to our investment criteria and find some companies that we think have sort of 50, 60, 70% upside, but with much lower level of valuation.
Got it. I want to talk about interest rates because we are in an environment that no one's seen before. We've got rock bottom interest rates. I feel like we say that every year, but certainly right now, given the government's response to the pandemic, rates have been pushed down to extreme levels. Have you had to adjust the way you look at stocks because of it? Anne, I'll start with you.
I think we continue to have the same disciplined approach than we ever had. I think that low interest rates make the stocks we have in the portfolio even more interesting because it's stocks companies where you have high barriers to entry, you have pricing power, they're going through restructuring phase, and the free cash flow yield, which if you want is the equivalent of an interest yield for a stock, is double digit. So we think this is an interesting proposition in these markets.
Gord, what about you?
Similar to Anne, we have not changed our framework in terms of our discounted cash flow hurdle rates, and we believe that it's really important in this time to keep a similar and repeatable and standardized process. But there's no doubt that low interest rates have encouraged some bad behaviors. And one that we've been especially worried about is a lot of people have taken on a lot of debt to finance their operations. And it's all great when interest rates are basically zero. In Europe, you can, a well thought of corporate issuer can issue bonds at zero interest rates. And that's, Solomon, you and I can borrow $1 trillion at zero interest rates. But if rates go up a bit, we're both bankrupt. And so we've tried to make sure that all of our companies have fantastic balance sheets. Keyence is one of the companies we own in Japan, and it has net cash on its balance sheet. And, Japan's been suffering from deflation for, decades, and we think they know how to operate in sort of very low interest rates environments. So that's one of the things we're looking at quite heavily right now.
I'd like for someone to loan me $1 trillion if that's possible. I don't know how that application will go. Gord, just staying with you on that, interest rates impact financial companies in a few different ways. How have they impacted some of the companies you have in the portfolio?
One company that we've owned for a while, again, you're getting the sort of sense that I care a lot about the downside protection of our portfolio. One company we've owned is CME Group. It's a Chicago Mercantile Exchange. And, it's a very defensive holding. And last year it suffered a bit because interest rates were dropping and everyone thought they were going to drop forever and drop to zero. And 50% or so of their business in terms of average daily volumes is with respect to interest rate futures. And so, this year, as interest rates have started to rise and volatility has started to rise in the interest rate market, CME is actually doing better than most of the banks this year. But again, it's hugely profitable operation. It's very sustainable in terms of their operating models. And we think some of the banks, especially in Europe, are challenged and they may have a cyclical bounce, but longer term, we prefer an operation like CME.
And you've got a lot of holdings in financials yourself. Where have you chosen to invest?
Well, we don't have any bank in the portfolio, and that's because we like to understand the companies in which we invest, and banks are black boxes at the end of the day. In terms of insurance companies, I think last year our track record was mixed. We had some names like NN in the Netherlands that did really well. We also own Allegheny in the US, didn't do as well, but the CEO has a fantastic track record. I think even better than Berkshire Hathaway, Warren Buffett at Berkshire. So we remain confident for the long term. But at Velan, the portfolio is very much about idiosyncratic situation. And there is one name that did really well for us last year. It's AUR Real Estate. As its name indicates, it's a Japanese real estate company with a lot of office space in Tokyo, but specific office space in the financial district. They own the building in which the Tokyo Stock Exchange is housed and has been there for decades. So we really don't expect very high vacancy rate. What we like about the AWR investment case is the fact that they're redeveloping a new building that is going to bring double-digit increase in their revenues. And it was in a way a little bit of like an hidden jewel that was in the company. No investor was paying attention to it. And now that the completion of the building is almost there, that the building is almost entirely pre-let, the stock re-rated 25% last year.
Another area where interest rates can impact is currency. And Gord, this question's for you. Your portfolio has at least 50% invested in Canadian companies and the balance invested abroad. So how are you considering the currency and exchange rates when you're making decisions right now?
Well, thanks, Solomon. It's currencies are probably one of the trickiest things right now, to be honest. I started off my career as a foreign exchange trader at Manulife, and I'm glad that I went into equities as opposed to foreign exchange. But as I say, it's quite tricky. I mean, as you know, we have 25 stocks in our portfolio, and we're trying to find the best 25 companies, and we handicap it by trying to forecast an exchange rate. So if something has a 20% return, but we expect a 10% depreciation in a currency, then that's how we try to factor it in. It's a fairly basic operation, but as I say, the larger thing is we find more attractive companies and more attractive valuations outside of Canada than inside of Canada. And our current bias is that the Canadian dollar is run quite a bit based on commodity appreciation and the fact that Canada is viewed as a commodity country. But we think the increases in debt per GDP that the Canadian government's done is not setting up well for a strong Canadian dollar in the future. So we're keeping pretty close to the 50%.
This has been a great discussion, getting a sense of how differently you both have thought this through, and I think that's reflected in the portfolios. Final question to you both. In this type of economic environment, we often hear the strong will get stronger. And Gord, I want to start with you. Maybe give us an example of a holding in the portfolio that has experienced just that over the last few months through this pandemic.
Sure, Solomon. In terms of the strong getting stronger, I guess one of the companies we would identify where that phenomenon is played out is Brookfield Renewable Energy. As the name states, it's a renewable energy company with about 70% of its business in hydroelectric power. And that's a phenomenal business because it's virtually perpetual. And it has huge operating profitability north of 70%. They're able to use those cash flows to invest in solar and wind and build out a renewables franchise. And, with the new Biden administration coming in, there's estimated to be about 10 trillion invested in renewables over the next several years. And in case of the strong getting stronger, they've positioned themselves as the decarbonization partner of choice for companies like Verizon, JP Morgan, and Facebook. So having that huge presence and long-term operations of power, they're allowed to do that. So they've benefited tremendously. So I think the stock was up about 80% year over year so far. So it's done well for us, but we think it does well based on the need, with the United Nations 17 development goals, with the need for renewables. We think there's still a strong case going forward for it.
And for in your portfolio, an example?
It's true, Salman, that the stronger companies are getting stronger. And I think I would point out to Disney, which is a stock that was in the middle of their digital transformation. And because of the quality of their content, it has really demonstrated in 2020 that it was able to reach many more subscribers than it anticipated. They had a plan to reach 90 million subscribers in 5 years, and they did it just in 2020. And I think it highlights how these stronger business models the strong business model are getting stronger during the pandemic.
Well, thank you both. Thank you both for your thoughts. And like I said, we can see how, despite having slightly different perspectives on this, you've built strong portfolios, and we're hoping that the results bear out in the near future. Thank you both.